Welcome to the Market Review podcast with Overberg Asset Management. With me today, I have Nick Downing, CEO, and Sean Fitzpatrick, our investment analyst. Nick will start off by discussing the global markets with us, and then thereafter we will be hearing from Sean on the South African updates.
I'll get straight into it. I know there's a lot to discuss at the end of Q1, and I must admit it hasn't been a particularly good quarter for the markets generally. Of course, the performance of our portfolios has dropped in line with the markets. How concerned should we be about the markets? We are not too concerned. Economies are generally strong, the US economy especially so, and the Eurozone economy is getting better all the time in very quick fashion. The Eurozone economy will get a lift from the massive fiscal policy shift that took the markets by storm during late February and March. And despite the economies being generally strong, of course, the Federal Reserve and other central banks have got plenty of ammo. They're on standby. And for those who don't know, this is known as the Fed put. So if there's trouble in the markets, the Fed is on standby, has the ability to turn sentiment around by injecting liquidity into the markets, either through quantitative easing or through interest rate cuts. But it's not just the Fed put that gives us reassurance. It's also the Trump put. Trump is also on standby to launch pro-growth policies and possibly to scale back some of his trade tariffs. So with a strong economy, continued earnings growth, and both a Fed put and a Trump put, one should be buying on market weakness. US growth fears have increased in recent weeks, driven by the Trump administration's sizable proposed tariffs and enacted tariffs. The administration's focus on reducing federal government spending and an overall elevated sense of policy uncertainty and somewhat weaker consumer confidence and consumer spending as a result of all of this. It looks like the first quarter GDP in the US will be negative. The closely watched Atlanta Fed's GDP Now index indicates a meaningful contraction of 2.4% quarter-on-quarter annualized GDP in the first quarter. Tariffs have probably caused most of the shift in market sentiment. We had 20% tariffs initially imposed on China, 25% tariffs on Canada and Mexico, 25% tariffs on steel and aluminium, and then the 25% auto tariffs. These alone increased the US effective tariff rates to around 18%, the highest since 1940. And that's before we consider the reciprocal tariffs announced on the 2nd of April, lifting that effective tariff rate to the highest in more than a century. But of course, it's testament to the strength of the global economic growth that the markets haven't fallen more in reaction. And of course, we do have the Fed put to provide reassurance, and more importantly, the Trump put to rescue the markets if indeed necessary. And I just want to turn here to something that's quite interesting on the tariffs. I won't go into all the details. We know that Vietnam, China, the Far Eastern countries have been affected the most by the reciprocal tariffs due to their sizable trade surpluses with the US. And interestingly, the least vulnerable, the one least affected, is probably the UK economy, with only a standard across the board 10% tariff. But I just want to quote here, in fact, excellent research again from MRB Partners. And this is something that hasn't been broadcast in all the newspapers and TV channels, and maybe slightly more interesting for our listeners. An underappreciated consequence of US tariffs is the impact of an enforced reduction in the trade deficit on foreign investment inflows. Independent macroeconomic research firm MRB Partners summarizes the predicament succinctly. I quote, "A trade or current account deficit must have a financial and or capital account surplus as an offset. Hence, any reduction in the US trade and current account deficit will have as its corollary a decline in foreign investment in US financial and non-financial assets." End of quote. The US has run a trade deficit in each of the last 49 years and a current account deficit in 43 of the past 44 years. The quid pro quo is that foreign investment inflows into the US have been vast, amounting to $13.1 trillion over the past 10 years, averaging an annual 5% of GDP. The rest of the world now holds $56 trillion of US financial assets, equivalent to 180% of GDP. A forced shrinking of the trade and current account deficits would lead to an exit by foreign investors, potentially leading to a material compression in US asset valuations. And this is why, possibly surprising President Trump, is that the markets dropping the most, besides Vietnam, today has in fact been the US market. The currency dropping the most has been the US dollar. And we wouldn't be surprised, of course, if there's some repeal of these trade tariffs. So let's see what independent macro research company Capital Economics has to say. This is their opinion. They're extremely well regarded in the market, and I am quoting, "As was the case last summer, we think the US stock market will bounce back from its growth scale, even if tariffs are involved this time round. The S&P 500 is down about 9% since reaching an all-time high on the 19th of February. And this is roughly the same drop in terms of magnitude between the 16th of July and the 5th of August 2024. Then and now, two similar trends have unfolded. First, the big tech stocks led the downward charge with an index of the Magnificent Seven stocks registering falls of between 15 and 20%. This time, we also suspect that the S&P 500 will rebound before too long. We suspect that those tariffs wouldn't be enough to push the US economy into recession." So, end of quote. Although we do expect GDP to drop in the first quarter, we forecast a rebound in Q2. If we are right, investors' attention would in our view return to the potential gains from AI, which appear much larger for equities in the US than for those elsewhere. What's more, and this is again Capital Economics, we suspect that the deterioration and sentiment from tariffs would hurt equities outside the US more versus, well, similar to what happened during the trade war in 2018. Equities in the US will rebound soon and reach new highs before the end of the year, and they will outperform equities in the rest of the world. So that's the end of that segment. We're now going to turn towards the considerable market rotation that we've seen in markets. There's been a considerable market rotation into Europe, especially over the past month or so. Economic data have generally surprised to the downside in the US, whereas they've done the opposite in the Eurozone. And there's been a shift in the performance of those respective markets. It's, in fact, only the second time since 1998, more than 25 years ago, that Eurozone equities have risen despite US equities falling by more than 5%. Equities in Europe, which account for nearly half of the global stock market, excluding the US, have performed particularly well. This is primarily reflecting Germany's historic policy shift towards more spending and in turn a more supportive fiscal policy. JP Morgan Cazenove have got this to say: German fiscal news flow has prompted big forecast revisions among JP Morgan's macroeconomic teams, with our economists upgrading German GDP growth projections by 1% for 2026 and calling for a multi-year fiscal tailwind for the Eurozone. For Eurozone equities, greater fiscal stimulus, a more bullish China outlook, of course China being a big trading partner with the Eurozone, as well as the potential ceasefire in the Ukraine, are all supporting elements. So let's dig a bit deeper into Germany's fiscal stimulus. Germany's parliament, the Bundestag, has agreed to reform the debt brake, the strict constitutional fiscal rule that limits the federal government's structural core budget deficit to 0.35% of GDP. As a result, historical defense spending exceeding 1% of GDP will become exempt from the rule, and also exempt is a substantial deficit finance fund for infrastructure and the green transition, worth a whopping 500 billion euros, amounting to a massive 12% of GDP, which is going to be spread out over 10 years. In other words, 1.2% of GDP per annum. It's massive, in fact, historic. The major shift away from Germany's traditional, very conservative and debt-averse fiscal policy will have substantial economic and financial implications. Another beneficiary of this big rotation from US markets has been China. In China, the waxing and waning of expectations for stimulus have been a big driver of the fortunes of the stock market there in recent years. But since late January, Chinese equities have received an additional boost from enthusiasm about AI stocks. Following the breakthrough there with DeepSeek, the more supportive stance from Chinese policymakers towards the tech sector has also helped sentiment. And on top of that, we've had a broadening in earnings growth across different sectors of the economy. So this is very good news. MRB Partners, another independent research company heading into this year, we felt that consensus forecasts for earnings were on the high side, and hence some modest recalibration of profit estimates was likely. Given the outsized strength of Q4 earnings growth, it is not surprising to see profit growth slip back into a more normal range in Q1. The magnitude of the downgrades has not been alarmingly large by historical standards. The earnings downgrades appear to be mostly driven by company-specific issues rather than reflecting broad-based economic concerns. Let's see what comes up next. I just have to say that Overberg Asset Management, we're long-term investors, we're conservative investors. We've been looking after our clients effectively for the last 23 years, and we are used to market volatility. Portfolios are managed, diversified across asset classes, across countries and currencies, and the emphasis is on capital preservation as much as capital growth. So we won't be reacting in a knee-jerk fashion to these latest tariff increases.
Thank you, Nick. That was very insightful. Next up, we will be having Sean to share with us his highlights within South Africa.
Inflation. The CPI figure was released for February 2025. The stat remained unchanged since January, coming in at 3.2% year-on-year, which was also below expectations of 3.4%. Month-on-month, there was an uptick of 0.9%, but it isn't too much to be concerned about, as February is known as a high survey month. The medical aid and medical services component, as well as fuel price hikes, contributed to the month-on-month increase, and those increases were mostly expected, so there's no surprise there. Saying that, fuel prices are still actually in deflationary territory compared to a year ago. Core inflation, which excludes food, non-alcoholic beverages, fuel and energy, fell to 3.4%, which is its lowest since December 2021. As many of you may know, the latest MPC decision was to keep rates unchanged. I think we're a little disappointed with that one. There is plenty of fat built into the repo rate, which currently stands at 7.5%, leaving prime at 11%, and we are still in the low end of the target inflation band of 3 to 6%. So, if not now, then when? One could argue that the MPC is aiming at reducing the target range altogether. The committee is clearly concerned about upside risks to inflation given all the uncertainty around US tariffs. As mentioned in prior monthly updates, they are treading with caution. Overall, though, the inflation indicators are very positive, and although the MPC doesn't use the CPI statistic in determining their interest rate policy, we do hope to see further cuts as we move into Q2 2025. Moving on, we have the ABSA PMI figure for March 2025. So, I'm sure you're all starting to get sick of the word sluggish when it comes out of my mouth. Thankfully, today I get to avoid it. Kind of. The latest ABSA PMI might not all be sunshine and rainbows, but it is a noticeable improvement. The reading came in at 48.7 for March, which is the highest it's been since October last year. The mildest contraction in a bad 5-month stint was propped up by a significant improvement in the business activity sub-index, which rose by 7.7 points. Although that may not put an end towards contraction in manufacturing, I see it as a massive positive as the pace of decline has slowed. An increase in export demand also drove new sales orders, leading to a jump of 10.2 points to 48.9. Major positives were the employment index that rose, manufacturers decreased their stockpiles, and cost pressures eased, thanks to a decrease in PPI as well as the strengthening of the ZAR. All that being said, the external environment remains volatile as well as unpredictable, which weighs negatively on business sentiment. Now just a few notes on domestic trade. Real retail sales surged by 7% year-on-year in January. That was led by a rise in sales of general dealers, where we saw an increase of 8.4% year-on-year, as well as retailers of clothing, where we saw an increase of 10.1% year-on-year. Real motor trade sales also performed better, mostly due to second-hand sales, with an increase of 8.8%. However, first-hand sales also saw a significant improvement. Eyes will likely be on this industry going forward due to the uncertainty around tariffs being imposed by the US. So, looking at the always exciting political landscape of South Africa, the main topic of discussion continues to be the budget, or should I say Budget 2.0. A quick summary of Budget 2.0 that was tabled a few weeks ago shows both negatives as well as positives. Let's do a quick run. A proposed total VAT increase of 1%, spread over 2025 and 2026, with 0.5% in each respective year. Income tax brackets are not being adjusted for inflation, which could cause certain individuals to earn a lower real income if they experience the infamous bracket creep. Eskom debt relief is to be reduced. Public sector wage bill and grants are increasing. And there's a considerable increase in planned infrastructure spend, which is definitely the main positive. However, when 22 cents of every tax rand goes to servicing debt, it doesn't come as a surprise when people ask the question, but where is the growth plan? Anna highlighted the less than 2% annual GDP growth SA has been experiencing for the past decade. Yet, he failed to address a clear, concise plan on how to change that for the better. Not unexpectedly, the DA continues to stand in the ANC's way, with plenty of anticipation around what the outcome will be regarding the VAT proposal. This is arguably the toughest test the two largest parties in the GNU have faced to date, and could in fact open the door for the DA to potentially, and I quote, share in the development of economic and policy for government. If they agree to the VAT increase, even only for the first year, just for a 0.5% increase, it could be a step in the right directions. Beware though, dancing with the ANC, someone is bound to get their toes stepped on. Negotiations are still ongoing. Watch this space.